do you mean that I'm sitting on a gold mine with my house? How do I use that to buy an investment property?
Most people will have mortgage for some time, and the property market is always moving. So what you'll find is your actual LVR, or your loan to value ratio in your home, is actually improved.
Loan to value ratio.
Yeah.
So what does that mean?
That's how much of the loan that you still owe on the house. If you have a LVR of 60%, it means that you still own the bank 60%, but you actually have 40% equity in the house.
Yeah.
You can use 20% of that equity to buy your investment property.
Right, and how do I do that?
First of all, we would refinance your home loan, and then we would refinance it to also include the equity amount.
Right.
So you would get two portions of the loan.
Mm-hmm.
The first bit of the loan is just your normal loan, and then there'll be a split portion that you can use as a deposit for your investment property.
Why would you recommend me doing that?
Everyone knows that property is in use the right way. You can leverage it to build wealth.
Yeah.
And certainly this is the way that you can easily do it. If you refinance your mortgage, you don't have to come up with the deposit. You're pulling the equity out of your home to make that next purchase.
But that means I get a bigger mortgage and I still have to pay that mortgage.
The portion of the loan that's used for the investment property is generally be tax deductible.
Just to be conservative, why wouldn't I just keep putting money into my existing mortgage to pay it off?
Because the property market is always moving. You'll spend forever trying to pay it off. This is a way where you can take on a little bit of risk, but you can build wealth a lot quicker.
Do you have to have a very high income paying job to do that?
Not necessarily, because that portion of that loan would be treated as an investment property.
Can I do the same thing if I wanted to renovate my house?
Yep, you certainly can. As simple as refinancing, using equity for that purchase. The downside, I guess, is you would have a larger mortgage.
Like, is there any requirements to be able to refinance?
All you need to do is to be able to service a loan. What a lot of lenders will actually do is they won't take into account the full serviceability buffer. So a lot of loans, you have to be able to service it with a 3% buffer. Normally with a refinance, they take it as a like for like, as long as you're getting a cheaper rate, and that generally means that they will service it without that buffer.
What advice would you give to a young professional who maybe just starting on their mortgage journey?
I guess the first question you need to ask yourself is, everyone thinks that you need 20%. You can get in with just a 5% deposit. To save that extra 15%, just to save $20,000 in LMI insurance, the property market moves fast, so you might as well jump in as soon as you can. Then you want to do is try to pay down that mortgage as fast as you can.
Right.
Build up the equity, extract the equity when you can, and buy an investment property, and then rinse and repeat every 2 or 3 years.
How much do you recommend paying off before you look at an investment property?
You need to have 20% equity as a minimum. So you want to pay that house down to your LVR to be 60%. Banks have changed and taken on different risk profiles. It's another way of them trying to also help more borrowers get into the market. LMI is really a lot of people...
So what was LMI again?
LMI is Lender's Mortgage Insurance. It's actually an insurance that the bank takes out in case you can't pay your mortgage. But here's the thing, they make you pay for that insurance premium, and that's what you pay when you borrow under 20% deposit.
Can you go around that?
There are certain aspects that you can go around it. It is to do with what industry you work in. So for example, doctors, nurses, lawyers, they can actually get a waiver on the LMI fee, because what the bank likes to see is they see those industries and those professions as very stable.
As the risk is lower.
Yes, that's right, definitely the risk is lower. The best rate out there for a loan is generally the one that's in your home. What you can do, if you're paying credit cards and there's 20% interest rate on that credit card, or you've got a personal loan and there's 15% interest rate, you can bundle that all together and then you can refinance the loan. What happens when you refinance is you generally reset the term of the loan, what means it actually brings down your payments lower. So what you'll find if you actually put that against all of your debts, you'll find that your repayments are actually lower when you refinance and consolidate your debt.
But you have more debt because if you're refinancing to build a kitchen or something, you're taking money out of the loan and your loan will be bigger. How is your debt smaller if your loan is bigger?
You're resetting the payment term. So let's say you still had 20 years to go on your mortgage. You would refinance and you would reset the repayment terms to 30 years.
This is only for younger people, I guess, not retirees.
Well, retirees you can, because you can unlock that equity, and then your house is just going to keep going up in value, and so there'll become a point in your life where you want to sell that property. That will clear the debt anyway.
What's your target market like?
My target market is, first of all, first home buyers, also refinancing. If you're not happy with your bank and they're not giving you a good rate, or you want to save some money, I would certainly help you out there. Also focus on refinancing to release equity, and that could be for a range of things. It could be anything from using it as a deposit to buy your first investment property. Also take out that equity and invest it in the share market. It's the age-old debate, property versus the share market. The truth is the share market is actually better than the property market.
Is that right?
Yes, we actually have a lot of clients that just use the equity to build up their share portfolio. What I always tell clients is you want to invest in property first, and ultimately what you want to do is you want to have a bit of a split between shares and property. The good thing about property is easy to leverage, because you can release equity in your house, say $100,000, and then you can use it to go buy $1 million. So you've essentially leveraged your money 10 times.
You can't do that with the shares.
With shares, it's a lot harder to do that.
Someone like me, for example, you would recommend to release some equity to invest in the share market.
If you built up a lot of property, or you paid down your house, and especially if you're getting older and you're not in a growth aspect, really building up a property portfolio, it's a young man's game, really.
So you got time on your hands.
You normally do that first, because property looks after you with time. More of a set and forget asset. You try to accumulate as many investment properties as you can. Then once you get to a certain level, you then switch to a phase where you want to pay down all of that debt.
Yeah.
And so you might sell a few properties to do that. And then all of a sudden you have more equity in your house, and you can extract that, diversify into the share market. The good thing, I guess, about the share market versus property when you get to that stage, especially when you're getting older, you've probably also experienced this as well, is tenants can be really hard.
So you think the younger people, like the Gen Zers, they have a chance to go into the property market with their avocado feta on toast, can't afford property anymore?
What I would just say is try as hard as you can to get on, because that's just going to get a lot worse very quickly.
Would you recommend buying a place that you can afford that you don't want to live in, rather than a place that you can't afford that you do want to live in?
Well, a lot of people are doing what's called rent investing. They actually rent somewhere that they like to live, and then they'll actually, instead of buying their first home, they'll actually buy an investment property. And that might be in an up-and-coming area where they might see double-digit growth in the next few years. They'll hold on to that property for a few years, then they'll either keep it as an investment property or sell it. Most likely they'll keep it as an investment property, extract that equity, and then go off and buy their dream home.